Okay, so last time we spoke, we talked about the Fed using open market operations to target the federal funds rate. But we really didn't talk about what that rate actually is. Is the Fed aiming for an 8% rate, a 6% rate, and how do they decide what that number is? So in 1993, a professor of economics at Stanford named John Taylor, whose picture is here on this slide, came up with a formula to describe how the Fed was targeting the federal funds rate that was remarkably accurate. And that formula is written for you on this slide. So the I stands for the interest rate, which is here the federal funds rate. So that's I. And we can also consider that the nominal interest rate. And the reason is because the federal funds rate really sets the tone for all short-term interest rates in the economy. So it's, accurate for us to think about the federal funds rate as kind of the nominal interest rate in the economy. This R star here is what represents what we call the natural rate of interest. So the natural rate of interest is just generally speaking, the federal funds rate, quote unquote, naturally, or when the Fed isn't trying to kind of affect the economy and the economy is just functioning normally at full strength and full employment. So, in general, we know, for instance, that when interest rates are higher, it's harder to get money. So it's harder to spend or invest money, so growth suffers. And we know that when interest rates are lower, it's easier to get money, so it's easier to spend or invest, and so growth results. But the natural rate of interest is that interest rate where the economy stays the same. Then we have this symbol for pi, okay, representing the rate of inflation. Okay, so pi star, so we have pi, that's just the rate of inflation, but then we have pi star, which is actually the inflation rate the Fed wants to target, where the difference between the two, this term right here, is called the inflation gap. Okay, Y represents current GDP, and Y star represents potential GDP. So in other words, GDP when we are running at reasonable and full capacity. And the difference between the two is the output gap. Okay, so this is our Taylor rule. Now the figure on this slide, and so I'm just going to compare his formula to the actual Federal Open Market Committee or Federal Reserve target for the federal funds rate. So this is actually right from your text, figure 18.7. And so in orange, we have the rate or the federal funds rate that would have been targeted according to Taylor's rule, given the formula that he had given. And then in green, we have that it's the Federal Open Market Committee target. So this was the actual target that was set by the Federal Reserve. And then in orange, we have, what Taylor's rule said the Fed was going to do and target. So that, we can see from this slide here, I have time in years on the x-axis and the federal funds rate on the y-axis. And we can see, it starts in 1990 and clearly there's something to the Taylor rule. It starts in 1990 at nearly the actual FOMC target over here. It declines into about 1994, so they both do. It increases into to about 2000, drops with it into 2002, rises again through about 2007, declines with it into 2009, and then stays roughly stable after 2011. But obviously and clearly there's some spots where the FOMC target or the Federal Reserve's target for the federal funds rate was actually below the rate implied by the Taylor rule. And that's what I have circled in red. So it's about 1992 to 1993, maybe 2002 to about 2005, and 2008 to 2009. And what we might notice first is that all three of these instances where the actual Federal Reserve's target for the federal funds rate is actually below the rate implied by the Taylor rule, these are during a downturn. It's either, at its trough or on the way there, okay, in the case of the 2008 period. So this might be explained by fear of the Fed in hitting what's called the effective lower bound. And this is when we get into negative interest rates territory. Okay, so remember when the federal funds rate target being lower than what the Taylor rule would have predicted means that the Fed was actually sort of trying to inject money into the economy at a rate that's actually higher than what the Taylor rule would have predicted, or monetary policy is actually looser than what the Taylor rule would have predicted. And so what I'm saying here is that the Fed actually, one reason why is that this is during a downturn or a crisis, and the Fed is scared of hitting what we've called the effective lower bound. So, and that's what I'm about to explain. So, remember, the federal funds rate influences all the short-term interest rates in the economy. So it ends up affecting mortgage rates, the interest rate you get from keeping your money in a savings account, loan rates, etc. And the basic mechanism is that when it's easier for banks to borrow, that ease trickles down to you. It becomes easier for you to borrow. When it gets hard for banks to borrow, it gets harder for you too, because as the costs banks have to pay to borrow increase, that increase gets passed to you. Okay. So now remember that during a crisis, the Fed is trying to lower the federal funds rate to put more money into the economy to stimulate it. At the same time, economy-wide interest rates are falling too. So that's why right now, if you look, the average interest rate on savings accounts is currently 0.09%. I mean, that's nearly zero, nothing. And 30-year mortgage rates are about 3.7%. Okay, now think about that kickback on your savings account, that 0.09% that you and everyone else gets as interest on your savings account. What happens if that goes to zero? Okay, so of course that means that you're getting nothing from putting your money into a savings account at the bank. Now, of course you could say, all right, well, if that were to happen, I'll just take my money and put it somewhere else. But, think about what's also happening right now. We're dealing with a coronavirus crisis, and typically where there's higher yields, there's higher risk. So it's a risky environment and probably not the best time, to start taking some risks. So the bank, for a reasonable person, would look like, the safest bet, even at a 0% interest rate, because there's a cost to taking your money out of the bank. I mean, think about it. Most of you probably have an online account. You have an app on your phone that's connected to your bank. You pay all your bills online. It's automatically hooked into your bank account number. You're used to the way your bank does things, the way the app looks, how to find what you need to find. So, maybe even if your bank was to drop the kickback to your savings account down to zero, maybe you're still willing to keep your money with the bank for safekeeping and for convenience. But then the question becomes, okay, well, how far can we take that? What's the limit? What if the Federal Reserve drops the federal funds rate down so low that it turns negative? And that trickles down to you too. So, in other words, would you pay to have your money held at the bank? Now, some of you might think that there might even be a price you'd be willing to pay, to keep your money at the bank for the reasons I, already mentioned, the convenience, the safekeeping. your funds, at the bank are safe and it's convenient for you to pay your bills, etc. But how much? How much are you willing to pay for safekeeping and convenience? Are you, think about that. Are you willing to pay, $1 a year for every, say, $100 you've saved in the bank? Maybe that seems fairly reasonable. $3, that still seems reasonable. $10, $25, $50 for every 100 you have in the bank. So clearly there's a number. Clearly there's a number where you would stop and say, forget it. I'll just hold my money in cash and start delivering payment, I don't know, for my bills on my bike or something. Whatever it is, whatever that number is that will make you switch from bank deposits to cash, that's your effective lower bound. Okay, that is your effective lower bound. The money, the penalty to keeping your money in the bank that makes you switch from keeping your money in the bank to just cash on hand. Okay? Now think about what happens if you're not alone. If all depositors end up withdrawing their money at this effective lower bound, then what? Well, let's take it to an extreme. Let's say the federal funds rate drops so low that every depositor removes all their money from every bank. Well, what happens? Banks don't have any deposits, meaning that money is being lent, that no money is being lent, so the deposit expansion multiplier is effectively, done, extinguished. Banks have no reserves because why do they need reserves if they have no deposits? And then what? How's the Fed supposed to fix something like that? What do they lower the federal funds rate? Lowering the federal funds rate is what caused this problem in the first place. What about if it increases the federal funds rate? Well, it could, but we can't expect it to go above zero because it was the Fed's efforts, to fix the economy. They got it to zero in the first place. And so some might argue that the Fed is in a trap here, what we would call a liquidity trap. And the reality that is, in some ways it is a trap, but it's not really, right? The tools that the Fed has to use at this point are powerful, but they're unpredictable. And so they have tools. It's just that they haven't been tested and true. They're experimental. So the Fed is somewhat hesitant to use them. So it's in a trap in the sense that, its alternatives are questionable, are unpredictable, but it still has tools. So I don't know that I would call it a trap per se. Okay, so in these red areas, to get back to this graph that I've circled, effectively what we're seeing is that the Fed knows the economy is in trouble. And what it's trying to do is lower the federal funds rate target dramatically during the early phases of the downturn. It's trying to catch it early so that the problem doesn't get so bad that the Fed is left driving the federal funds rate down to that effective lower bound where people switch to cash. Okay, so that's why we see these times where the Fed is actually having looser monetary policy than even what the Taylor rule would suggest. On. Okay, so let's go back to the Taylor rule for a second and just think about what this equation actually tells us about the behavior of the Federal Reserve with regard to the way it targets the federal funds rate. So first thing is that this equation tells us effectively that when the rate of inflation, or pi in this Taylor equation we just talked about, when that equals 1 and everything else stays the same, so we can effectively ignore it, then the federal funds rate, or I, increases by 1.5 percentage points. Why? Well, if my inflation increases by 1 percentage point, that means I have a 1 here standing in for pi. And it means that I also have a 1 standing in here in place of pi. Now, if everything else stays the same so that I can effectively ignore it, then what do I have? Well, I is going to equal, here is an increase of 1, right? And then here is an increase of 0.5 because we have 0.5 times pi. So when the inflation rate increases by 1 percentage point, then we'll get that the federal funds rate will increase by 1.5 percentage points. Okay, and we'll talk about, why that makes sense. And, the short answer is, well, it makes sense because an increase in the federal funds rate is a tightening of monetary policy, and that makes sense when when you have inflation. Okay, but the second thing that we see is that if inflation increases by 1 percentage point, then the real interest rate increases by 0.5 percentage points. Okay, so when inflation goes up, so does the real interest rate. Okay, this we know from using the first rule as well. So when the rate of inflation increases by 1 percentage point, then the nominal interest rate, okay, or I here, we also know increases by 1.5 percentage points. So this I here becomes 1.5 percentage points. And we said when the rate of inflation increases by 1 percentage point, so we have 1.5 minus 1, and this is the formula for the real interest rate. Remember, it's nominal interest minus inflation. Okay, so we get 1.5 minus 1, and that gives us 0.5. So we have that increase is the real interest rate, which I'm representing by R here, increases by 1.5 percentage points. Okay, and this also makes sense, again, for the same reason. Increase in inflation indicates a tightening of monetary policy that, makes its way through nominal interest rates and the real interest rate. And then the third thing that we see is that when the output gap increases by 1 percentage point. So remember this difference here of current output and potential output is what we call the output gap. And if you remember back to macro, when you had a supply and demand model of a long run equilibrium, so you had the long run aggregate supply curve, remember where that aggregate supply curve hit the x-axis, you had potential output. And if your short run output was greater than that potential, remember, you had an inflationary gap. Okay, so what we're effectively saying is that when this output gap increases by 1 percentage point, that means our current output is greater than our potential output. And when that happens, notice, so if this was to go up by 1, this whole term, then in order to find out what happens to the federal funds rate, assuming that everything else stays the same, we'd say, okay, well, this is 1 times 0.5. So the federal funds rate goes up by 0.5 percentage points, all else equal. Now, again, what does all of this say? Well, it says in general, when we see inflation in the economy or when we see an inflationary gap, monetary policy gets tighter. The federal funds rate gets higher. Okay, and so that happens in the real interest rate, the nominal interest rate, and also for when the output gap increases. Okay, great. So let's talk a little bit more specifically about the discount rate and about discount lending. And this is the Fed stepping in as a lender of last resort. So the current form of discount lending, whereby the discount rate is 1 percentage point higher than the federal funds rate, and the lower stigma that's attached to borrowing from the Fed, especially during times of crisis, this current form of discount lending was only introduced in 2002. So prior to 2002, the discount rate was actually lower than the federal funds rate, but it carried a really heavy stigma to borrow from the Fed. And so it was so harsh, that stigma, that banks rarely actually did it. And that's because effectively borrowing from the Fed was a serious signal and sign that your bank was in serious trouble. And banks, that did it regularly really risked not being able to borrow funds in open markets again. But the problem with that system, where the discount rate was even lower than the federal funds rate, but that there was a really, a real serious stigma attached to borrowing, the problem is that it created a lot of volatility in the market. So in the same way, think about, your grades and how they might look, the volatility of your grades, if you can't, say, reach out to your professors for some leniency during bad times, right? So rather than reach out to the Fed, during early signs of severe distress when something could be done to put the bank back on track, banks pretty much waited until the death knell sounded, so to speak, before they asked for help. So in 2002, the Fed instituted a new system whereby we basically said, hey, instead of keeping the bar low and making you all beg for help, we're just going to raise the bar. And if you can reach this bar, then it means you deserve our help, and you should get it more or less stigma-free, and especially during times of crisis. So we basically said, up goes the discount rate over and above the federal funds rate. We also said loans have to be collateralized, that is, banks borrowing from the Fed have to give it something the Fed can seize in the case of default. And if they don't have that collateral, said the Fed, then, they're not responsible and shouldn't be helped anyway. And the list of what counts as collateral is fairly broad. It includes U.S. Treasury securities, commercial paper, consumer loans, commercial and agricultural loans, and even some mortgage obligations. Now, the Fed doesn't just disperse one type of loan through discount lending. It actually disperses three, depending on what the borrower looks like, generally speaking. And the more risky the borrower, pretty much the higher the hurdle in the form of an interest rate that they have to pay, which makes sense. The higher the risk, the higher the yield. So the Fed disperses three different types of credit: primary, secondary, and seasonal credit. And I'll talk about the first two because those are the largest forms of discount lending and the ones most relevant to monetary policy. And as we go along, you'll see that in some of the slides, I hyperlink some of the words to an article about, how maybe the Fed is acting currently in terms of, in this case, disbursement of primary and secondary credit. So it increased its disbursement of primary and secondary credit very recently. And so a link to that article, if you want to check it out, is hyperlinked to the word disperses. So primary credit is reserved for the most sound of banks, and it's typically dispersed on a really short term, usually overnight basis. In order to determine the soundness of a bank, the Fed's bank supervisors rely on what's called the CAMELS rating system. And those different CAMELS, every letter in the word CAMELS, each letter stands for one of the categories that rating system uses to determine the bank's strength. So I'm not going to ask you about this, but in general, just so you know, it's capital adequacy, assets, management capability, earnings, liquidity, and sensitivity to market risks. And the ratings run from 1 to 5, and 1 is the most strong bank. So primary credit is actually only dispersed to institutions with a rating of 1 or 2, so the strongest of those banks. Now, the interest rate that's tacked on to this loan is called the primary discount rate. Okay? And it's typically, when we talk about the discount rate, just plain old discount rate, what we really are referring to is the primary discount rate. Okay? And as we already know, it's above the federal funds rate, though it's the lowest of the discount rates. Okay, so it's lower than the secondary discount rate or the seasonal discount rate. And the way that the Fed reasons is that these stronger banks can get access to these funds so long as they are willing to pay the penalty of an interest rate that's higher than the federal funds rate. And so right now, the primary discount rate is 0.25%. So to give you a sense of this primary discount rate, relative to its history, we can take a look at the following graph. So this is the daily primary credit rate, or the primary discount rate, from January 2003 to April 2020 from the Fed. So on the x-axis, and I gave you the Fed code there if you want to take a look at this yourself. So on the x-axis, we have time, and on the y-axis, we have percent. And currently, the Fed's primary credit rate, or discount rate, is the lowest it's been in roughly 20 years. So the closest we got, actually, to a discount rate of 0.25% is, looks like about right here, December 2008 to about February 2010. But even here, the discount rate only fell to 0.5%. So we're very low relative to the information presented in this graph. Okay, let's take a look at secondary credit. Okay, so while primary credit is, for the best of the best, so to speak, secondary credit is for those, it's a drastic sort of change. It's for those with nothing to lose. So secondary credit is available to those institutions that can't qualify for primary credit. And so as a result, the secondary discount rate is set above the primary discount rate. And a bank's willingness to pay this rate to access loans is a serious signal that it's in trouble. So the only banks that would take this hit to their reputation are those effectively that would fail without this loan, but whose problem is such that the loan may actually fix it. So there are institutions that are really standing on a knife edge. And because of the signal that taking these loans send, these loans are not very popular. So during the financial crisis, for instance, secondary credit represented roughly 1% of discount lending. So it's not very popular at all. Now, what about reserve requirements? Okay, so far we've been considering reserve requirements that are fixed. We were given a reserve requirement and then told the Fed purchases, a U.S. Treasury security, and then we were asked to calculate the deposit multiplier. But why doesn't the Fed, just change the reserve requirement if the level of reserves affects the economy? So surely if you lower the reserve requirement, you put more money in the economy. And if you do the opposite happens. So why doesn't the Fed take that route? Why doesn't it employ that strategy? Well, the answer is actually twofold. One is that one of the reasons is that it's the same practically as why the Fed stopped using changes in the level of reserves to affect monetary policy in general. And that's because right now there's a ton of them. So if you remember from our last class, we discussed how the Fed increased the supply of reserves dramatically during the last crisis in 2008. And as a result, we can't, move out of a near zero federal funds rate without dramatically reducing the supply of reserves. At the same time, we don't know how such a large reduction in the level of reserves will affect our economy. What happens when you remove that large amount of reserves from the economy? We don't know. Okay. So one reason we're not using required reserves as a policy tool is owing to the current circumstance, which kind of just makes it naturally useless. But the second reason why the Fed doesn't change required reserves is because during financial crises, banks tend to want to keep their money with the Fed regardless of disincentives. So, in other words, even if you dropped the reserve requirement down to spur lending, banks would still be willing to keep their money in the bank anyway, or at least we have some experience of that. So, for instance, during the Great Depression, less than half, so $5.6 billion of reserves were in the system, and less than half of that actually had to be there. by requirement. The rest of it was excess reserves. It was there by choice. So one of the things that the Fed started to worry about at this time was, okay, well, whenever banks suddenly feel like they want to lend, all of that excess is going to be used to create deposits and increase the money supply. So prices are definitely going to go up dramatically. We'll get inflation. So what the Fed did was to counter that possibility was double the reserve requirement in August 1936. But to their surprise, banks' excess reserve balances came back. So banks started to save over and above the higher reserve requirement. And so the reason being because banks were afraid. And so rather than go out into the open economy and start lending, what they were doing is hoarding money. So for multiple reasons, reserve requirements are not used as one of the Fed's policy tools. So I want to think about inflation targeting. I want to move away from reserves for a second, because that is part of the Federal Reserve's mandate, not just about sort of controlling interest rates and keeping them stable, but also to have low and stable inflation, or to preside over low and stable inflation. So remember, inflation targeting, the way that the Fed sort of goes about achieving this goal of low and stable inflation is most recently through what's called inflation targeting. And it's pretty much as simple as it sounds. So this is where a central bank makes a public announcement of an explicit inflation target and focuses on achieving that target inflation rate. So this is, the bank coming out and saying, we're not just going to target low and stable inflation. We're going to tell you exactly the inflation rate that we are trying to achieve. Okay, so currently it's 2%. So that has only been around since, in general, for all central banks in the world globally, since the 90s. So it's forward guidance, and we talked about that before, forward guidance as a policy tool. But doing this, inflation targeting is forward guidance in the sense that the Fed is telling everyone the exact rate of inflation it'll be working on. And what does it hope? Well, it hopes that the public finds this number to be credible, meaning it's achievable. And it also finds the Fed to be credible, the Fed to be trustworthy. And so what it hopes is that if people expect inflation to be low, for instance, and stable in the future, then this stimulates growth because interest rates decline. So remember, from our earlier classes, that expected future inflation adds to the price of money, in the sense that if I expect, that I give you $100 loan today, and that $100 loan that I give you today will only be able to buy $90 worth of stuff in a year when you pay me back, then I'm going to tell you, hey, you know what? I'll give you $100 now, but when you pay me back $110 instead of $100. Okay, so that I can get the same purchasing power from the loan that I'm repaid. Or to continue it, if I expected $100 today, will only be able to buy $80 worth of stuff in a year, then maybe I'm going to ask you to repay me even more, maybe $120 when you come back around. So what the Fed is hoping by telling you, hey, we promise that we're going to do everything in our power to make sure your $100 today is worth $100 in a year. That I'm then, or you are then, or we are then going to keep our interest rate low. Okay, so, and most specifically, banks will keep their interest rate low when they lend $100, say. Okay, so now many countries that have their central banks explicitly targeting inflation, they have the central bank focused on inflation as the primary or most important role for that bank. So, for instance, countries like Australia, Chile, South Africa, and the UK have what's called a hierarchical mandate for their central banks. That means that, the central banks have a ton of different goals, but they aren't on equal footing. They are not. And inflation targeting takes precedence. It's the primary, the top objective of the central bank. The US is a little different in that the Fed has what's called a dual mandate. So achieving low and stable inflation is just as important in theory as achieving high employment. But it's actually really interesting to note that there's been signals that that's changed, even though it hasn't changed in fact. So in January 2012, it's fairly recent, the Federal Reserve announced a specific inflation objective, but it didn't announce an employment one. So it said we're going to specifically target 2% inflation, but it didn't say anything like we are going to specifically target a 3% unemployment rate. If the unemployment rate goes above 3%, we're going to step in to bring it down. So they didn't say that. And so some take that as the Fed considering controlling inflation is more important than full employment. And so I'm just going to show you a quick sort of news clip of this inflation target being discussed in 2011.
Michael?
Well, it'll be new for us, but it's been used around the world. The Fed's holding $1.5 trillion in excess reserves for the nation's banks, and if they were to start lending that, inflation could explode. That at a time when it's already shooting up. Fed officials tell us setting a target would, in theory, reassure Wall Street and Main Street that they have prices under control.
It's the best of times because you've got this very easy monetary policy in absolute terms. So people are worried that the central bank's going to let inflation get out of control.
Essentially, this would be a promise by the Fed to raise interest rates if inflation rose above the target, cut them if it fell below. When prices fluctuate as much as they have lately, that creates uncertainty, can lead to higher long-term borrowing costs, slow growth. To set a target, policymakers must first choose an optimum rate. Chairman Ben Bernanke has suggested 2%, and they have to decide how it would be measured. Most Americans follow the CPI, while the central bankers prefer the Personal Consumption Expenditures Index. They would also have to determine a time horizon for hitting the target. Now, there's no guarantee it will happen, but it's something Bernanke has long wanted. And as I said, Deirdre, more than 20 central banks around the world now use this strategy.
Reassure.
Okay, hold on, let's go. Let me move past this.
Lawmakers and
Okay, so are there any questions up to this point on this? Okay, so let's go ahead and move to the next slide. Okay, so now that we've covered the Fed's tools and goals in normal or conventional times in some depth, let's go back to unconventional times and review that in some depth as well. So we said last time that unconventional times are characterized by times when we can't lower the federal funds rate anymore. So interest rates have reached the zero lower bound. And the transmission of monetary policy is effectively broken. So, reserves are rapidly depleting and don't respond to the Fed's conventional policy tools. So, in these circumstances, the Federal Reserve starts to get unconventional with the times, and we're actually, seeing a lot of continuation of this unconventional behavior that initially started in 2008. And that's a really important point. Our Federal Reserve has dramatically changed since 2008. 2008 was a really pivotal time in changing the way the Federal Reserve operates. And so, when we learn about when we learn about institutions, We are used to them having a really long history and having done things for a really long time in the same exact way. That's really not the case for the Federal Reserve, and that has a lot to do with the fact that the Federal Reserve presides over a sector that's also rapidly innovating and changing and experimenting and failing and getting back up, and that's the financial sector. So a lot of what we are learning about unconventional monetary policy, is really, really recent and would be, unheard of back before the 2008 financial crisis. So we already talked about forward guidance last time. And remember, this is where the Fed starts to get really specific about what it's going to do in the future to try and calm any fears about what might happen in financial markets and the part of the real economy the Fed can affect. So I want to get more specific about another unconventional policy tool, and that's the purchase of Treasury securities and risky assets. And we talked about this, but I just want to get more specific about how the Fed actually does this. So last time I remember getting the question about quantitative easing, and so we're going to talk more specifically about what that actually is. So the Fed's purchase of Treasury securities and risky assets can become what's called quantitative easing. It's not quantitative easing automatically, okay? And now we can be a little bit more specific about what quantitative easing actually is. Okay, so like I mentioned, it's not just a simple purchase of Treasury securities and risky assets. It's the purchase of those things beyond a certain level. And that level is the level of purchases that's required to get the federal funds rate to zero. So in other words, if the Fed is purchasing and the federal funds rate gets down to zero, then any other purchases after that point is quantitative easing, okay, for our purposes. So for instance, say we're at the first equilibrium in this model that we saw last time. Ruined my surprise. Okay, so we're at this first equilibrium that's actually, this first equilibrium. Where is my marker? Okay, the first equilibrium. And this is our equilibrium is after 2008. No, this is the right slide. Okay, so this is after 2008, and we're here at this first equilibrium. Perfect. And then let's say that conditions in the economy really start to decline so that the Fed starts buying Treasury securities and risky assets. So it's pushing the supply of reserves out so far that the federal funds rate drops to zero. Okay, so let's just say, let me put it in there and see if I can let's just say we're right here. Okay, so we increased our supply of reserves so much that there's our straight supply curve, and remember there's a horizontal part that comes off of the end to represent elastic lending that I'm not drawing just for clarity in the graph. But then let's say my equilibrium is right here. Oh God, but it's right here. Okay, so that the federal funds rate is zero. Technically, this is not yet considered quantitative easing. Okay. But now let's consider if the Fed keeps going. So if it keeps buying Treasury securities and risky assets past this point. Now, if that happens, then we technically have quantitative easing. Okay? And we can locate it very specifically in this model as the space. Okay? It's the space between the demand curve's first intersection with the x-axis, or where the federal funds rate is zero, and that second equilibrium, where the supply of reserves is beyond what's needed to get the federal funds rate to zero. So obviously, when the Fed adds to reserves beyond a point where the federal funds rate is below zero, it's doing so to stabilize asset prices and encourage banks to lend. So we continue to see economic growth. And clearly, in theory, it has to be possible that the Fed can achieve these goals. I mean, let's take it to an extreme. If the Fed simply buys the entire economy, which I would actually say it's on its way to doing right now, then prices have to stop falling. I mean, that's just a matter of absolute fact, right? How can prices fall if there are no sellers? But what about encouraging some modest inflation or getting prices to rise by creating some buyers? Isn't necessarily the case that the other goal of the Feds to encourage banks to lend will necessarily be achieved? Not really, and we already touched on this. So in a downturn, it's possible, that banks are happy with the Fed just putting money in their reserves and don't decide to lend them out because they don't want to take on the risk of doing so. And we talked about this in the context of the Great Depression. It also happened in Japan in the 90s. The country's central bank tried to add to bank reserves, but lending continued to decline because Japanese banks were trying to deleverage and reduce their assets relative to their capital. So they were trying to reduce the amount of loans they dispersed relative to the deposits they had. So even though their bank reserves were enormous, lending continued to fall. Okay, so that hampers kind of the effectiveness of quantitative easing. But quantitative easing can still be useful if it's somehow tied to investor expectations. So, for instance, if investors expect that the Fed will keep its target federal funds rate at 0 while it's engaged in quantitative easing, then the continuance of quantitative easing is more, or at least the utility of it is more as a signal. It's a signal to investors that the target federal funds rate continues to be 0. So generally speaking, the process is largely experimental, but during unconventional times, the Fed doesn't really have a choice but to start experimenting. And we have some ways, especially in our current day, that this process is not only experimental, but to some degree, much less effective. Okay. So in this graph here, to give you a sense of the difference in Fed's assets and reserves, and I know we talked a little bit about the change in the Fed's balance sheet over time last class when we reviewed the data exploration exercises, but I've just plotted it here for you again. So for instance, here in the light blue, we have the Fed's assets before the crisis, after them, and the y-axis is in trillions of dollars. So we had that the Fed's assets prior to the crisis is about 0.9 trillion. After the crisis, it was closer to about 4.5 trillion. Currently, the Fed's assets are something in roughly $6 trillion. So, we can somewhat see the scale of this crisis just by virtue of the fact of the Fed's assets or balance sheet. Over on the right, we have the level of excess reserves in the economy. So again, notice that before the crisis, the level of bank reserves was actually fairly low. Something looks like to the tune of, say, 0.3 trillion. After the crisis, it shot up to about 2.5 trillion, and that level is still the same now. But it had actually dropped. I'm going to show you now two graphs from the Fed. This one on the bottom, you've already seen. And the level of excess reserves through time in our economy is on the top. So I'm trying to give you a long view of these levels with these graphs. And as we can see, while the level of reserves dropped, so the level of reserves at banks dropped to about 2010 levels, it looks like, before that, so somewhere around here prior, it shot up more steeply now than it did from 2012 to about 15-ish, when this level was growing rapidly. And, this could be on account of the gravity of this situation, but we should also keep in mind that the Fed is a little bit more comfortable now using some of the unconventional tools it devised in 2008, right, that led it to build up its reserves. I know, for instance, I'm much more quick to use something with expertise after I've tried it once. So, and then we talked about last time, the Fed's balance sheet is currently larger than it's ever been before and seems to have increased at a more rapid pace than it even did back in 2008. Okay, forward. So another strategy through which the Fed purchases Treasury securities and risky assets is through targeted asset purchases. And in reality, this is more of a trade than a purchase. So the Fed is effectively trading one asset for another of a specific kind. So its balance sheet, doesn't grow like it does with quantitative easing. So rather, its makeup or the composition of the balance sheet changes. So in other words, to buy a Treasury security, just pure and simple, is quantitative easing, so long as that purchase is beyond what's needed to drive the federal funds rate to zero. But to sell a Treasury security the Fed already has and swap it out for a mortgage-backed security, so to buy a mortgage-backed security afterwards, because the Fed, say, wants to prop up prices of mortgage-backed securities, that's a targeted asset purchase. Okay, so this is akin to saying something like, you buying, say, a bottle of hand sanitizer adds to the amount of stuff you have, okay, and to your assets. That's your quantitative easing. But to trade that hand sanitizer for toilet paper of the same price is not quantitative easing. It's a targeted asset purchase. Okay, the level of your assets didn't change. You swapped out sanitizer for toilet paper, but the composition changed. Now you have toilet paper instead of hand sanitizer. So the impact of targeted asset purchases is greater in some markets than in others. So in a thin market, and what we mean by thin is one where there's not many buyers or sellers and where the market is illiquid as a result. So in other words, it's hard to find a buyer. That's a market that's not liquid. Then targeted asset purchases are more successful at stimulating economic activity for the simple reason that, the Fed is entering as a buyer. And when there aren't, is entering as a buyer where there aren't many buyers. And prices are falling for that asset as a result. So in those markets, what the Fed can do relative to what's there already is greater. Okay. Targeted asset purchases is also more impactful in stimulating economic activity where it can drive down an interest rate differential. And what an interest rate differential, and what we mean by that, is just the difference in yields between two assets so that they become more similar, so that investors are more likely to substitute one for the other. And in that way, the demand for both of them increases. So let me give you an example. Let's say the price of mortgage-backed securities is $3 a security with a high yield. And the price on a short-term Treasury securities, let's say, is $10 with a low yield. Remember, prices and yields have that inverse relationship. Then by buying mortgage-backed securities, the Fed can possibly drive the price up of mortgage-backed securities and drive the yield down. And they can, in doing that, make it more similar as an asset to a Treasury security and hopefully stimulate demand as a result. Okay, so that's what we mean. So the drawbacks of targeted asset purchases, one is that they're unwieldy in the sense that it's a fairly new tool, and we don't fully know the effects of it yet. And the second thing is that, it favors some users of credit over others. So targeted asset purchases deviate from what's called asset neutrality. It's not neutral in the asset that is being purchased. So they're targeting something. So for instance, if you're someone who owns a whole lot of commercial paper, or say in the current circumstance, corporate debt for instance, then, in targeting corporate debt for a purchase, then obviously you benefit more than somebody who holds another type of asset. So it's not neutral in the way that it sort of helps different holders of credit. So the second drawback comes from the fact that a targeted asset purchase is typically targeted, like we mentioned, in those markets that are less liquid, or where you have less buyers. So when the Fed goes to sell these assets, it might have a hard time finding a buyer. Okay, so this is kind of akin to saying, just give you an analogy, if you go to the store right now, and let's say you buy up a ton of caviar, okay, because nobody wants it and the price is falling, then you might have a hard time selling that caviar when the worst is over. Okay, so of course, it's possible that you won't have a hard time. It's caviar, but typically recovery from a crisis takes a really long time, and we can't really be sure that the people who were buying caviar before will be able to buy it again soon, or if they're even going to have the appetite for it anymore once all is said and done. Okay. So just to give you some sense of numbers, during and after the crisis, the sale of targeted asset purchases was large. So 1.8 trillion was purchased in mortgage-backed securities, and 2 trillion was purchased in long-term treasury debt. So currently, so that was, before and after the crisis in 2008. Currently, the scale of targeted asset purchases can technically be infinite, because it could be technically as large as the Fed's balance sheet, which is currently unlimited. So, if you know, for instance, the Fed has effectively come in and said, we're going to buy an unlimited amount of Treasury securities. So, targeted asset purchases is, currently potentially unlimited, which is a totally unprecedented situation. Okay. So, finally, another tool that the Fed uses to purchase Treasury securities and risky assets and to directly lend to banks or non-financial institutions are what's called facilities. So a facility is simply an unconventional and temporary monetary policy tool that the Fed uses to add liquidity to the economy, or just put money into the economy during an emergency. So on this slide, I've listed some of the facilities that the Fed created during the 2008 financial crisis, and I indicated here whether they've been resurrected yet. So, and also, just for your reading, if you're interested, in response to whether or not the facility has been resurrected, I included a news link if you want to follow up on the announcement, or some who've criticized. So for instance, where a facility has not been resurrected, you've seen some criticism of the Fed saying, hey, you have this left to do. You have this tool, this facility that you created in 2008, and you could resurrect it now to help fix this problem, and you haven't yet. So if you're interested in following up on that, the news links are there. And if you hit a paywall with the Financial Times, just let me know and I'll send you a PDF of the article. But I think you get like 3 free articles with the Financial Times, so you should be okay. But just email me if you're not. So in this chart, I'm not going to expect you to memorize this chart or anything. I want you to just get a sense of what these facilities look like. So we can see a number of different programs, like the primary dealer credit facility. And these facilities, for instance, lend directly. So this facility lends directly to what are called primary dealers, and they're non-bank institutions that are effectively approved to trade securities directly with the U.S. government. They're the first buyers of government debt, and then they go and sell that debt in the markets effectively where you and I can get them. So then you have other facilities that lend indirectly. So for instance, the money market investor funding facility, a mouthful here, funds another institution, or what's called a special purpose vehicle, to lend out to money market mutual funds. And you have other facilities like the term auction facility there at the top that hasn't been resurrected yet, that we talked about last time, that helps institutions get funding. So if you remember, that term auction facility essentially went out into the open market and announced that they have banks that they vetted and that are offering collateral. They're looking for funding, and they got the Fed's thumbs up. And so by auctioning this debt, the Fed is helping these solid banks get funding. So I would say that these facilities sort of fall into three different categories. Either this is the Fed lending directly, it's the Fed lending indirectly through some other sort of institution or vehicle that it's funding, or you have that it helps something get funding. So I would say these facilities, from what I've seen, I mean, it remains to be seen if they create any new ones, but so far this is what I've seen. And they have actually. So for instance, on March 19th, I think it was, the Fed actually created a new facility just for this crisis called the Money Market Mutual Fund Lending Facility. And it was just an effort to help money markets keep up with investors who wanted money. It's being managed by the Boston Fed, and the Fed's just hoping to shore up market functioning and credit provision. So it also lends to municipal bond markets, since municipal bonds are a big part of money market mutual funds. Okay, so the takeaway from this chapter, so it's fairly straightforward. Up to 2008, the Fed was dealing with conventional times, and so it could use conventional tools to control monetary policy. Tools like open market operations to change the supply of reserves that affected the federal funds rate and the rest of short-term interest rates in the economy to spur growth and keep inflation stable and low. So that was normal times. 2008 was unconventional. And so the Fed responded in an unconventional way, including, by adding so much money to the economy in the form of reserves that it kind of made reserves valueless. So, it kind of removed the scarcity. Where there's no scarcity, there's no value. And that's effectively what the Fed did. It made reserves less scarce. Now, to use reserves again as a monetary policy tool, it requires sucking out of our system a whole ton of money. And in general, we just really don't know what the impact of that will be. Okay, so rather than do that, in the meantime, we have some tricks, that are unconventional and unpredictable, but they're powerful. So we talked a couple of them, including lending in the open market directly, using the interest on excess reserves, or the IOE rate. And we said, and telling people what the Fed is going to do, just so that everyone stays calm, or what we call forward guidance. And going forward, at some point, the Fed is going to try to return to its normal self. It will, once things calm, it will try to return to its conventional role. And the question going forward will be, can it go ahead and return to its normal role without affecting markets? We saw that it had some trouble doing that right before the coronavirus crisis, and it kind of remains to be seen whether it will ever be able to return to that role.